Welcome back to our intermediate financial accounting class. In our last segment, we were talking about pensions. We talked a lot about the conceptual issues behind pensions and the logic and the classifications and the categories. What we didn't mention then that I should have is that difference between defined benefit and defined contribution pensions is one of our key concepts. And remember, with that defined contribution, it's a really easy accounting journal entry. Debit pension expense, credit cash, and I'm done. Defined benefit takes a lot more work, and we talked about all the different information we would need to provide for defined benefit plans. Now it's time to jump into some steps and learn how to actually account for those defined benefit plans. A lot of fun. Let's get started. There are a lot of different pieces to calculating our pension, and because of that, we're going to break it down into a lot of different steps. And we're going to do some examples as we go so we can kind of highlight each step. Let's start with the basic steps. And if nothing exciting, quote unquote, is going on with your pension, these 3 steps and the journal entries that go with them would be all you'd need to worry about. And then once we've talked about those, then we'll add in some of the more exciting stuff. The first thing is we need to decide what our beginning balances are. What do we have in our pension plan assets that we've saved? What do we think we owe as our pension obligation? And then we look at those accumulated other comprehensive income accounts and see what has built up over time. Once we've got the beginning balances, then we start making some adjustments for what we call normal income. You see, certain judgments have to be made every single period. We need to adjust for what we call service costs. This is when we give people raises, or we fire some people and hire different people, or the mix changes because we have some people stop smoking that were smoking, or that have started exercising, which is something that, the people I work for don't ever have to worry about, that all start exercising and maybe live longer, so they have to keep paying me. Those changes change our mix, and it's caused by the service our employees are giving to us, or who's providing the service to our business. So we call them service costs. And that we'll get a note usually from our actuary who's looked at all of our wage numbers and all of our employee data, and they will say, based on the service provided by your employees this year, the raises you've given, length of tenure, accrual of benefits, etc., you need to increase your pension obligation by $3,000 or whatever, and we'll make that adjustment. That happens every year because our employees work more and they earn more pension, etc. Second are interest costs. Now, when we record a pension, we don't record what we think we're going to pay in 20 years. Just like we do with a note payable or a bond payable, we record it at its present value. And the good news is we have an actuary do that because it's really complex. There's a lot of statistics and number crunching that goes on to get that number. But because we have our pension obligation as a present value number, as we get closer to having to actually pay those numbers out, we have to, what FASB calls, unwind the discount. Meaning we're going from the discounted value down here, this is the discounted value today, and we've got to move it up to the actual payments that we're going to be making. So over time, we'll record interest expense that jumps us up this line to what we're actually going to pay. So every period we'll record an interest expense that allows us to make that adjustment from present value to actual. The third normal every year adjustment is what we call expected returns. Basically, we look at what our assets are in our pension plan and we make an adjustment for how much we think those plan assets are going to earn during the year. And we account for how they're going to grow over time, what we've saved now to what we will have when it's time to start paying out this obligation. So over time, our plan assets will grow just because of interest. And that's what this expected return is it's accounting for the growth of the asset. So you have these 2 numbers, the discount and the amount that we've saved, working together to change our pension obligation. And we have to account for that every period. In addition to these normal adjustments, we have a couple of non-expense items that don't affect pension expense, but do affect our obligation and our plan assets, cash, etc., and ultimately affect our pension journal entry. Yes, we're getting closer to that journal entry. The first thing we account for are the contributions that are being made to the plan. So whatever cash we decide to put in, it gets saved into plan assets. We need to make sure we account for that. We also account for any benefits the plan has already paid out, because once they've paid them out, I'm not obligated to pay them anymore. So we'll keep track of that. We'll look at our actual returns, not our estimated amount, which is what we were talking about over here, but the actual amount that our pension is earning. And then finally, we'll do actuarial adjustments. And this is where the actuary comes back and says, you know, our statistical models have changed. So we now have better, more accurate estimates on what the people working for you that are smokers are going to cost you later on in healthcare. So we have to change our percentages and our numbers to account for these new statistics. Step 1 and 2, all of those happen every single time. Step 3, almost always happen. Not always, but almost always. We usually make a contribution. If people have retired, we're starting to make payments because of our obligation to them. We have actual returns. That happens almost every year unless the market doesn't make any money and things just stay static. And then the actuary may or may not send us some numbers. So these usually happen, but not always. And that's why we break them out separate. That, and again, they don't affect the pension expense, just the rest of the journal entry. Enough of these details. It's time to start some calculations. And the first thing you need when you do pension calculations is what we call a pension worksheet. Now, a pension worksheet is going to be different for every company. They'll have their own Excel spreadsheet or a file that they use or whatever program they're using. So it'll look a little bit different than what you're seeing here, but all of them will look similar to this. Before we move on, make sure you've got a copy of this worksheet so that you can walk through these examples with me. So here's our first example. At the end of year 2, FHL Incorporated reported only a PBO balance of $120,000. That's our projected benefit obligation, or the amount we think we'll owe. We've got plan assets of $130,000 that we've saved up for this pension. So at the moment, we are fully funded because the 120 is less than the 130. In year 3, the actuary estimated that our annual service cost was $15,000. Again, that's changes based on how my employees have served or worked for me during the year. Our discount rate is 12%. That's what helps me make that adjustment from present value to future value that I'll actually have to pay out. And FHL's estimated return on assets will be 10%. During the year, the company contributed $5,000 to the fund, and the plan paid out $17,000 to retirees. At the end of year 3, the investment management company reported that the ending value of the pension plan assets was $120,000. So these are all the numbers we need to know to do a basic pension expense calculation. And I'm going to bring up a table or worksheet so we can see it. Now, because I'm trying to work in PowerPoint, I just want to warn you, I'm not going to write out all the thousands and all those zeros. I'm going to round everything to the nearest $1,000. So instead of saying that we have 120,000 in my PBO, I'm just going to put it as 120. And just know I mean 120,000. I just don't have room to put it in here, or you won't be able to see it. Now, the secret to the worksheet, before we do any more with this, is this note down here at the bottom. And again, every company will have their style, but this is pretty standard. The debits we're going to list as positive number. Anything that's a credit will have a negative number. So my obligation would be a liability. Liabilities have a credit balance, so I'm going to list it as negative 120. And my plan assets were 130,000. Again, I'm going to abbreviate it. So I put it in 130. It's a plan asset. That's a debit. So I leave it as a positive number. We have no prior service costs and no actuarial gains or losses because we were told that the only balances they had was this 120 and this 130. The last thing we're going to look at is the funded status, and that's going to be the difference between these two numbers. So let's see, 130 and 120 gives me a difference of 10. The debit is bigger than the credit, so I'll list it as a debit of 10,000. This is, we call it funded status on our worksheet. This is our net pension obligation right here that shows up on our balance sheet. So last year's balance sheet showed net pension assets of $10,000. That's what that means. And this line right here, this was step 1. Next, let's move into our normal adjustments. That's this piece right here. These are the ones that happen every single year without fail. They're going to happen. And we're going to start with the service cost. Now, this comes straight from the actuary. And in this case, we were told that the cost was $15,000. So since it's a cost, I'm going to put that in as an increase to my expense, just like other costs. This is my debit. I need a credit. Well, because of the service they provided me, I owe them more in the future, which means it's going to increase my obligation, and there's my credit, increasing the benefit obligation or my liability amount. And again, that's got a credit balance. Next is our interest cost. And again, this is unwinding the present value discount. And we talked about that with the stair steps going up. What I'm going to do is take the discount percentage provided by my actuary, which was 12%. And the actuary gives me this based on the statistical methods he or she used, or the company used, to figure out what my obligation is today compared to what it will be over the next 40 years as I pay for these employees. I'm going to multiply that by the projected benefit obligation amount. So this number over here, I'm going to bring right down. And if I multiply that, 12% of 120,000, again, we're rounding, is 14,400. And so I would put that in here as 14.4 since I'm rounding. And again, it's an interest cost, so it's a debit to my pension expense column. And since I'm unwinding the discount, I'm trying to build up that liability to what I'm actually going to have to pay. So there's the credit there in my pension obligation. Next are my expected returns. And expected returns, again, we get a percentage either that we've come up with or that the actuaries come up with. This is what we think our plan assets are going to make for the year. And in this case, the company has estimated 10% as my estimated return, $130,000 in plan assets. So 13,000 will be my number. Now, what do I do with that 13,000? Well, the easiest way to think about this 13,000 is to think about what's happening in our asset account. That plan asset account is growing, not because I put anything into it, but because it's simply earning interest on however I've invested the money. If it's growing, will I owe more or less in the future? Well, I'll owe less because I don't have to contribute the money, it's building on its own. So the best way to think about this is that it's reducing the cost of this pension to my business. And reducing the cost is a credit to my expenses. So I'm going to put it in as a credit to my pension expense. Again, because the assets are making money, the pension costs me less. If it costs me less, the expense goes down. Now, I got to have a debit to that. And the debit doesn't go in plan assets because this is an expected return, not an actual return. So I can't put it in plan assets. And I can't put it in the obligation because, again, it hasn't really happened. So instead, I put it here in this actuarial gain or loss column. And we'll talk a little bit more about how that works later on. Now, we talked a lot about the basic steps. We've started filling in our table, but it's time to take a bit of a break. When we come back, we're going to move on past the expense piece and into some of the other less common, although still frequent, changes that need to be made and accounted for with my pension. I'll see you then. Thanks.